Get your free copy of the complete tutorial at www.teachucomp.com/free. Cost behavior analysis is the study of how certain costs behave in a business. Understanding cost behavior is crucial for managers so that they control costs effectively. The first step in analyzing costs is understanding and measuring key business activities. Activity levels are expressed in financial terms and can be in sales dollars, miles driven, and classes taught. The activity level should be correlated with changes in costs. The activity index identifies the activity that causes change in the behavior of costs. This allows managers to make decisions to further control costs. There are three types of costs: variable, fixed costs, and mixed. Variable costs are costs in a business that vary in total directly and proportionately with the changes in an activity level. For example, if an activity level increases 20%, total variable costs will also increase 20%. The proportion is the same if the activity level decreases. Examples of variable costs include direct materials and direct labor. For example, the more a company drives, the more gasoline expenses they incur. So if the activity level driving goes up 25%, the costs for gasoline and other driving expenses will also go up 25%. Fixed costs are costs that remain the same in total regardless of changes in the activity level. Examples include property taxes, insurance, rent, and salaries. Because fixed costs do not change with activity level, as volume increases, unit costs declines and vice versa. For example, let's say a company's rent was $10,000 a month. While the rent expense is constant no matter how much the company produces, the unit cost of each part produced will go down in cost as volume goes up. If the company produces 10% more parts in a month, the total cost per part produced will go down 10%. Mixed costs are costs that contain both a variable element and a fixed element. A truck rental is a good example of a mixed cost. For example, renting a truck has a fixed cost of $100, but also variable cost of 50 cents per mile. In order to classify and analyze mixed costs, managers use the high-low method. The high-low method uses the total costs incurred at the high and low levels of activity to classify mixed costs into their two components, fixed and variable. The difference in costs between the high and low levels represents variable cost, since only the variable cost can change as activity levels change. The first step is to determine the variable cost per unit. Then determine the fixed cost by subtracting the total variable cost at the high or low activity level from the total cost at that activity level. Understanding which are variable costs and which are fixed costs are important for managers in order to make decisions and ultimately control costs per product. Like what you see? Pick up your free copy of the complete tutorial at www.teachucomp.com/free.